rental properties is one of the best ways to build wealth, but are you maximizing your tax write-offs? There are huge tax advantages to being a real estate investor, but if you don't know what's deductible and what's not, you could be leaving money on the table, or worse, making costly mistakes. So let's break it down. I'm going to help you save money by understanding exactly what parts of your tax return of your rental property are tax deductible and what isn't. If you own investment properties, this is a must know, and this info can help you maximize your profits and avoid IRS headaches. So what can you write off? First, let's talk about the good stuff and what you can write off. These are your legitimate tax deductible expenses that lower your taxable income. Mortgage interest. If you have a loan on the property, the interest portion is deductible. Property taxes. You can write off property taxes paid on the rental. Depreciation. The IRS lets you deduct a portion of your property's value over 27.5 years. And repairs and maintenance. Fixing a leaky faucet, replacing a broken AC unit, deductible. Property management fees. If you pay a property manager, that cost is a write-off. Insurance premiums, landlord insurance, liability insurance, it's all deductible. So legal and professional fees, if you hire an attorney, an accountant, or real estate professional, their fees are also deductible. Utilities, if you pay them, water, electric, gas, trash, if you cover it for the tenants, it's deductible. And marketing costs, ads, listings, signs, whatever you spend to attract tenants is a write-off. And a bonus write-offs for smart investors, home office deduction. So if you manage your rentals from home, you may qualify. You also have travel expenses. If you visit rental properties for business, mileage and travel expenses may be deductible. LLC or business formation fees. If you have a legal entity for your rentals, those costs are deductible. So what isn't a write-off? Let's talk about what is not deductible, because not everything qualifies. Principal payments on your mortgage, only the interest is deductible, not the principal. That's money that's going to you into your savings account shaped like a property. Improvements and renovations, major upgrades like adding a pool or remodeling a kitchen, they're not immediately deductible, but they can be depreciated over time. Vacancy losses. If your property sits empty, you can't deduct that lost rent. And personal use expenses. If you use your rental as a vacation home part of the year, you can only deduct a percentage of the expenses. Security deposits you haven't used. If you collect a security deposit but don't use it for repairs, it's not taxable and not deductible. So pro tip, to maximize deductions, if you want to legally pay less in taxes, here are some expert investor strategies. Keep detailed records, save all your receipts and invoices, and mileage logs. Use a business bank account. Keeping rental property finances separate from personal accounts is really important. Work with a tax pro. A CPA or real estate tax expert can help you maximize your deductions. And leverage depreciation. This is one of the biggest benefits of real estate ownership. Bottom line, real estate investing comes with huge tax benefits, but you have to know what's tax deductible and what's not. And if you want to start building wealth through real estate and rental properties, and you need financing options that work for investors, I'm here to help. Drop a comment below if you found this helpful, share it with a fellow investor, and if you need your funding for the next deal, let's talk. We've got those DSCR programs and all the programs that you might want. Let's keep it going and help you build wealth through real estate.